I think what we need now is to flush out the auxiliary collapses that are going to occur because of accounts that, let's say, public mining companies had with FTX or other hedge funds that have obviously over the weekend gone to zero in their accounts. But we're not finished with the collateral damage. And so to your question, this is a bottoming process. An event like this is very important because it's finally going to have several impacts in areas that we need. It's going to accelerate regulation, number one. As we speak, I'm at the Governor's Conference in Orlando. This is topic number one in financial services. The amount of discussion going on last night and certainly today about this situation is going to move. It's definitely going to move legislation in the House. On Wednesday of last week, the whole world knew that there was a liquidity issue at FTX and that the hold on the balance sheet was somewhere between $6 and $8 billion. Now, I work in the indexing market for sovereign wealth and pension, and so we were getting a lot of inbound requests about information about the situation because that's the kind of money that an institution or a sovereign wealth fund can put to work if they thought there was an interesting opportunity. And in financial services, illiquidity events or liquidity events like this can be interesting investment opportunities if you think it's a legitimate investment and it's not going to issues with the regulator. So the timeline of that conversation is I put a message into FTX. I wanted to confirm the amount being requested. Was it going to be 6 or 8? Sam called me back, very, standard conversation. He was, rational, and we had that conversation about confirming what the amount was going to be. The amount was $8 billion. That's what they were looking for. So I went back to these various entities that were asking me about it. And by that time, the SEC chair was on the air around the world. I think the network was CNBC. And he made it clear that they were going to come down hard on this situation. So the minute that occurred, that was the end of any sovereign wealth fund's interest because they index in the S&P 500. They have to be compliant with the SEC. And so, if you're a sovereign wealth fund making $250 million a day, the only market you can put it into to park it is the S&P. It's liquid enough to absorb that. So they don't make moves against U.S. regulators. There was no way to get that $8 billion into or onto the balance sheet of FTX with the regulator hovering overhead. The truth is the FTX platform was very robust. It was very well designed. Hundreds of millions of dollars went into making that. And that's why there was sovereign interest and pension interest in the platform itself, because at that time, just before the gates came down, you got to remember, all of these funds got gated, towards the end of the week. And there they are sitting there. If somebody had provided the liquidity, and here's the interesting debate that was going on. Let me share this with you. So let's say your sovereign wealth fund, $8 billion is a rounding error for you. Do you really need $8 billion? And let's say what was on the table in the deal was ownership of FTX, which was on the table. So for whatever the amount is to keep FTX liquid and compliant, you could own it. Now, if you think about Binance and FTX, that's about 82% of the world's exchange. I mean, that's it. And that's a big, big chunk. So there was interest. And here's the real debate that went on. It really wasn't $8 billion required, because if you could put in, let's say, $2 or $3 billion, then open the gates and let anybody that wanted to get out, get out. The minute you open a gate, some large percentage doesn't use the gate because they feel they're safe and now can transact again, and they've got backing. That was the debate going on. My guesstimate, and it's only a guesstimate, is the number that could have cleared FTX and kept it solvent would be about $3.5–4 billion, which is not a heavy price to pay for what had been built up over those years. However, once you go into a situation where regulators are coming in, there's nothing you can do about that. But they didn't raise hundreds of millions, they raised billions. The cap table has pretty well every significant financial services behemoth company on it. It was considered for a while to be the premier compliant platform, in the sense that we had an American running it, an American creating it. That gave some people some confidence, maybe ill-advised. However, Sam Bankman-Fried is an American, and he's well known, and he is, no question, brilliant. I mean, when it comes to understanding blockchain and cryptocurrencies, very few people had his knowledge and his ability to build code around it. Remember, Serum is one of his projects as well. So he's well known in the community and a founder, and for a while, saving lots of other entities by putting cash into them. Where that cash came from is under question now, obviously. But the bigger question about this from the institutional perspective, and we're having this dialogue even today, is this does not kill crypto. This is one event that helps stabilize crypto. There's going to be a silver lining to this disaster. There's no question about it. It'll be called regulation. And I'll tell you why. It's not new regulation required here. You can look at any broker-dealer exchange tied in the U.S. to stocks or bonds or futures or commodities and have regulations that are protecting investors in the U.S. market. So it's not a big stretch to have the regulators finally say we're going to apply that to crypto exchanges the same way. Here's what we're doing. I'm just one investor, but I'll tell you. We're taking our positions and we're moving them to Canada. We're putting them into WonderFi and BitBuy. Why? Because it is the world's first regulated license issued to a broker-dealer exchange, all tied in one, under the order from the OSC. There is no optionality for commingling accounts. That doesn't happen in Canada. And in a really strange way, what I'm saying here is it's incredible that I have to go to another country outside of the US to finally find a place where I can put significant institutional assets that's regulated. Our regulation has fallen so far behind that I no longer feel comfortable putting significant amounts into anything that is not regulated under the OSC order. We actually got our financial statements off the FTX platform every 12 hours. So what we would do is we would mark to market our positions along with our stock and bond and private equity positions every day, which is what we're forced to do to remain compliant. So we would mark to market, even though, as we all know, crypto token prices change 24/7. But we forcefully used the platform to look at every conversion that had happened, every position that was on, whether it was gated or not, whether it was locked or not, and we would take that every 12 hours. And that platform was very robust. It would allow you to do that on every single position with a complete history of the conversion record, as it should and as the chain provides. But no, we didn't know they were commingling accounts, obviously. And when the gates went up, the phone calls went around the world, certainly part of that scrum. And people were trying to figure out, what was going on here. And that took about 12 hours. The Alameda situation, when you build a new blockchain, you basically want to get as many apps on it as you can. What gives value to Ethereum or gives value to Polygon is the fact that there are many, many apps being developed on it. Even Miston, which is brand new, coming out of the efforts of Evan Chung that's coming out of Facebook. He got funded immediately because of the potential of how many applications could come on it. But very often what will happen, and Alameda was being touted as this, you set up an institution that supports the development of a Serum or supports the development of a Polygon or supports Solana. And that was well accepted by many, many institutions, including all the institutions that you find on the roster at FTX. They understood that was what it was for. And indeed, if you look at what Alameda was investing in, was to support the ecosphere. So for many investors, that didn't seem untoward. And that may be questioned in the future. But more importantly, it would be the relationship between the accounts at FTX and Alameda. That's what's being alleged. That's where it's offside, and that's never going to be legal in any situation unless you sign a contract allowing it. And we're going to have to find out who signed what contracts as to whether that's legal. From my point of view, watching what investors do at the institutional level, this is going to help quite a bit in stabilizing what the rules are going to be, because crypto is not going away. And that is still of great interest to institutions that still won't invest in it because they don't have a platform to do it on. For me, it's moving under the Canadian order. I'm going to stay there until you can show me policy and regulation in the US. All of our assets will remain there. Because we've got a government, the government of Canada, through the Ontario Securities Commission, controlling, watching, regulating every single account there.